The average Canadian family earns about $5,808 a month after tax, and nearly half of it, around $2,880, goes straight to their mortgage. Here's why that matters if you invest in mortgages. I want you to picture what this means for the typical household. Before they can even think about groceries, gas, or saving for their kids' education, that mortgage payment hits their account. This level of housing cost pressure, both the biggest challenge and the biggest opportunity investors have seen in decades. But most people don't understand how we got to this point. They think it all started when rates went up, but the real story began much earlier. The crisis actually began during the pandemic years when borrowing money was cheaper than it had ever been in Canadian history. The Bank of Canada dropped interest rates to emergency levels, with mortgage rates hitting rock bottom at around 1.5%. This fueled a massive buying frenzy across the country. Banks were practically giving money away. The qualification process became incredibly lenient, with minimal down payment requirements and reduced income verification. Everyone believed real estate was the safest bet you could make, and lenders were competing to offer the biggest loans possible. Here's what happened to prices during those 2 years. Home values rose significantly, with the average Canadian home now priced around $690,000. Meanwhile, household incomes didn't rise at the same pace as house prices. Families found themselves competing for homes that cost substantially more than just a few years earlier. Let me show you the math that changed Canadian households. A $500,000 mortgage at 2% interest costs you about $2,100 per month. That same $500,000 mortgage at 5% interest costs you $2,900. That's an extra $800 every single month, or nearly $10,000 more per year. But most people didn't buy $500,000 houses. They bought homes closer to that $690,000 average because prices had shot up so much. Take a typical family that bought in 2021. With today's average home price of $690,000 and a mortgage of approximately $520,000, their monthly payment sits around $2,880 against the median after-tax family income of $5,880 per month. That mortgage payment consumes 49% of their entire household budget. When your mortgage eats up nearly half of your paycheck, everything else gets squeezed. These families are cutting back on groceries, skipping vacations, and many are taking on credit card debt just to pay for basic needs. This is how we arrived at the point where Canadian households now spend 49% of their after-tax income on mortgage payments. It wasn't just the rate increases that created this problem. It was the buying frenzy during the pandemic years when cheap money met expensive houses. The families who bought at peak prices are now trapped in payments they can barely afford. But while families struggle with these payments, something interesting has been happening with interest rates that most people don't understand. The Bank of Canada has made 4 rate cuts this year, but if you're waiting for mortgage rates to crash, I have some surprising news for you. The bank started cutting rates aggressively in 2024, dropping the policy rate from 4.75% down to 3.25% by the end of that year. Then they kept going in 2025. By June, they had made 4 more cuts, bringing the policy rate down to 2.75%. That's a massive drop of 2 percentage points in just 18 months. You would think mortgage rates would follow the same path down. But here's where it gets interesting. The current mortgage landscape shows something different. The gap between policy rates and mortgage rates is much wider than people expected. Fixed rates are staying stubborn for a reason. Banks have their own funding costs that don't move as fast as the Bank of Canada's policy rate. They need to pay depositors, they need to cover their risk premiums. They're also worried about future rate increases, so they build in extra protection. Let me show you the real impact with actual numbers. Take a $400,000 mortgage that drops from 3.99% to 3.7%. Your monthly payment goes from about $2,100 to $2,040 monthly. That's only $60 less per month. For families spending $2,880 monthly on their mortgage, this small relief barely makes a dent. The bank must balance these cuts against core inflation at 2.9%, above target, and shelter costs still rising at 4.5%, which keeps them from cutting more aggressively. These figures show the real underlying price pressures in the economy. Housing costs keep pushing core inflation higher. Rent increases and mortgage interest costs add up to that 4.5% annual increase in shelter costs. The bank can't ignore this when they make rate decisions. They need to balance helping homeowners with keeping inflation under control. Banks also worry about lending risks in this environment. More families are stretched thin with those 49% mortgage burdens. Default rates could rise if unemployment hits the projected 6.8% by late 2025. This makes banks more careful about pricing their mortgages even when policy rates drop. The 4 rate cuts created a situation where policy rates dropped fast but mortgage rates stayed higher than expected. This disconnect between what the bank is doing and what families actually pay creates something most people don't see coming. While homeowners struggle with these crushing payments, smart investors are positioning themselves for the biggest opportunity in a decade. The 49% problem creates both massive risk and massive reward for investors. Traditional banks are tightening their lending standards because they see the same stress signals we talked about. When banks pull back, alternative lenders step in. This creates a huge market for private mortgage investments. People still need to buy homes. They still need to refinance, but now they can't get approved through traditional channels. The numbers show this clearly. With the average Canadian home price around $690,000 and families earning around $5,880 monthly after tax, most buyers need substantial mortgages. Banks won't lend to families already spending half their income on housing. This pushes borrowers toward private lenders who charge rates that can exceed 8%. As an investor, you can earn returns that traditional bank investments can't match because you're accepting the higher risk that banks won't take. Regional diversification protects you against trade policy risks. The proposed 25% tariff on Canadian goods could severely impact export-dependent sectors. This favors domestic-focused provinces and markets with less U.S. trade exposure. For example, target Alberta's local service sectors rather than energy exports. You may want to focus on Quebec's domestic industries instead of Ontario's auto sector that's deeply integrated with Michigan. Model what happens to your investments if defaults increase. Plan for scenarios where the Bank of Canada delays rate cuts or even reverses course if inflation stays high. This is a contrarian play. While others fear the mortgage market, the best deals emerge during these transition periods. Distressed borrowers need solutions. Banks won't provide them. Investors who understand the market dynamics can step in and earn strong returns. The investors who understand this transition and position correctly today are setting themselves up for what comes next. The 49% mortgage burden isn't just a number, it's reshaping how Canadians live and creating the foundation for the next real estate cycle. Families are cutting back on everything except their mortgage payments. This changes spending patterns across the entire economy. By tracking rent growth, policy rate forecasts, and local job data, you'll spot high-return mortgage opportunities before the rest of the market. Watch shelter inflation trends in your target markets as they signal borrower stress levels. Monitor the Bank of Canada's path toward their 2.5% neutral rate through 2025. Track regional employment changes, especially as unemployment rises toward the forecast 6.8% by late 2025. Let me know in the comments which region you're watching for opportunities. If you enjoyed this content, be sure to watch my next video on where you should invest your $50K.